Tencent was Charlie Munger's last investment through the Daily Journal stock portfolio, but their stock price has gone up quite a bit since Charlie bought into the company. Is Tencent still a good investment opportunity? We're analyzing Tencent, stock ticker TCEHY, to see if its market price is a fair value. We're using the Select 6 analysis to look at the most telling financial metrics before estimating an intrinsic value for Tencent. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing Tencent for your portfolio. Before we get into these valuable metrics, let's understand Tencent stock performance. Currently, Tencent's ADR trades for $44.33 per share. Tencent is also traded under the ticker 700 on the Hong Kong Stock Exchange. In the last year, their stock price is down just under 2%. However, they've nearly doubled from their October lows. In the last 5 years, Tencent's stock price is down 15% overall. In the last 10 years, however, Tencent's compounding at 19% annually. Going back to the global financial crisis, in the last 14 and a half years, Tencent's compounding their stock price at nearly 28% annually. These are huge returns, outpacing almost every stock in the market. And Tencent's down more than half from their all-time highs. Right now, Tencent trades $20 above their 52-week low. The company's down $8 from their 52-week high. Tencent is one of the largest businesses in the world. They're the largest business in China. Right now, Tencent has a $425 billion market cap. But why should we be paying close attention to Tencent? Tencent is arguably the most influential internet firm in China, as one can hardly go by a day without using its products. Tencent is the world's largest video game vendor and owns the world's top-grossing mobile game, Honor of Kings. Tencent also runs China's largest social media super app, WeChat. The app is now part of the fabric of life for Chinese people who use it to chat, shop, watch videos, play games, order food and taxis, and more. Equally as impressive as its own portfolio, Tencent is also among the world's largest venture capital and investment corporations. The firm was one of the largest shareholders in leading tech companies such as Meituan, Didi, JD, Snapchat, Pinduoduo, Kuaishou, Epic Games, and more. Starting with metric number 1, we want their average return on capital in the last 5 years to be above 14%. There are two key reasons for this. Over the long run, over the course of decades, a stock's likely to return what its underlying business returns. These business returns will be captured here by return on capital. The average publicly listed business earns about a 7% return on capital. Looking for a benchmark that's double this allows us to build in margin of safety based on the quality of the business. Tencent's return on capital have declined in all 5 of these years. They've pretty steadily gone down, and the business has been hit by regulations in recent years. Averaging these returns out, Tencent earns about 11.5% returns on capital in a given year. While that's solidly above average, that's a couple percentage points below the benchmark we'd be looking for, meaning this is an X on metric number 1 for Tencent. Metric number 2, we're looking for growth in the business. We want to see 5-year growth in their revenues, net incomes, and free cash flows. This metric's all or nothing. All 3 have to be up for this to be a check. During this time, Tencent has grown their revenues by 77%. Their earnings have more than doubled, and their free cash flows have grown by 35%. This is big growth across the board for Tencent. Our first check of the day comes in here on metric number 2. Metric number 3, we're taking the perspective of an individual shareholder by looking for earnings per share growth in the last 5 years. As we just learned, Tencent has more than doubled their earnings during this time, and they've just marginally diluted existing shareholders, issuing about 1% additional shares. This leads to big earnings per share growth. This is another check on metric number 3. Metric number 4, we're looking for something similar. Here we're looking for free cash flow per share growth in the last 5 years. Like their earnings, Tencent has grown their free cash flows. This outpaces their shareholder dilution by quite a bit. Another check here on metric number 4 means that through our first 4 metrics, we have 3 checks and only 1 X for Tencent. But there's still one vital piece missing. You might think nailing returns on capital and having good growth is the key, but we haven't touched on the one thing that I believe sets truly wonderful businesses apart, which is having these characteristics without using a lot of debt. In metric number 5, we want Tencent's net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow the company has produced in their last 5 years. Tencent has increased their net debt position. Right now, they have about $9.9 billion worth of net debt. but the company has produced $96.7 billion worth of free cash flow during this time. They'd be able to pay off all of their net debt with only half a year's worth of their free cash flows. This is a monster check here on metric number 5. Tencent is a very cash flow generative business relative to the debt that they're using. Through 5 metrics, we have 4 checks and only 1 X. Before getting to metric number 6, it's time for our bonus. As our bonus, we're looking at Tencent's dividend profile. Tencent currently pays a modest 0.4% dividend yield. We're looking to see that this is supported by the company's free cash flows as they're starting to return this capital to shareholders. During this time, not only has Tencent grown their free cash flows per share, they've also grown their dividends per share, more than doubling their dividend per share payouts. In all 5 of these years, Tencent very easily and very healthily supported their dividend payouts. They maintain a very reasonable dividend payout ratio. While this is a snapshot of their last 5 years of performance, and it's no guarantee for the future, Tencent's dividend is very easily covered by their free cash flows and seems to be in pretty good shape right now. The big metric of them all, metric number 6, we want Tencent's average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It may offer a reasonable starting point for a valuation of Tencent. Tencent currently has a $432 billion total enterprise value. Taking into account both their market cap and their net debt position, it gives a perspective of Tencent similar to it being a private company. We learned Tencent produced $96.7 billion worth of free cash flow in their last 5 years, meaning in an average year, Tencent earns $19.3 billion in free cash flow. When that's divided by their enterprise value, that gives about a 4.5% average free cash flow to enterprise value yield. In their last fiscal year, Tencent earned $17.9 billion worth of free cash flow. When that's divided by their $432 billion total enterprise value, that gives about a 4.2% current free cash flow to enterprise value yield. Both of those are coming in above the yield of the 10-year treasury. However, they're slightly below the risk premium we'd be seeking, meaning this is an X on metric number 6. Don't throw this business out. There's still work to be done. Stick around as we come to a more concrete estimate for an intrinsic value for Tencent before giving our final rating to the business. Everything we've discussed so far is important, but there's still something missing that in my opinion is the main reason to analyze Tencent, which takes us on to using a discounted cash flow model to come to an estimate of a fair stock price for Tencent. A DCF model is based off the predictability of a company's free cash flows. Tencent's been a very predictable business in its past. Like any model in any discipline, a DCF's outputs are sensitive to its inputs. We're starting with a 3-year average of Tencent's free cash flows, then using historical assumptions to grow these into the future. It's up to you to figure out if these are accurate and applicable going forward for the company. Assuming Tencent grows its 3-year free cash flows at a rate of 10.5% annually for the next decade, then in the decade from there that this growth rate would be cut in half. If we add in the company's tangible book value, which gives us an estimate of their net worth, if we were seeking a 15% rate of return, which is the rate of return Warren Buffett's looking for from his investments in addition to his margin of safety requirements, from today's valuations, it looks like an estimate of Tencent's fair intrinsic stock price is around $31 per share. That fair value is $13 below the company's stock price right now. It's well within the range of where the business traded within the last year, as the company's 52-week low is around $25 per share. There are several key points to keep in mind. Just because Tencent was a highly predictable business in its past doesn't mean that that's a guarantee for the future. This 15% discount rate is an estimate of total returns to shareholders. And most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Before considering any investment decision, consult with your financial advisor. In just a minute, we'll give our final rating to Tencent, but we have to address something first. We focused a lot on the numbers, but Charlie Munger is known for looking at the qualitative aspects of a business. Let's look at those. Starting with the qualitative points supporting a potential long thesis for Tencent. Number 1, compliance costs can rise to a point where they become significant barriers to entry in the Chinese internet industry. Number 2, because Tencent is so deeply integrated within the Chinese daily life, it can easily test out new monetization methods and pick the best ones to implement. Number 3, many of Tencent's products are still in the early stages of monetization. Then for the key points supporting a potential short thesis. Number 1, there's the possibility of highly competitive foreign internet service providers re-entering China over the next 10 to 20 years. Number 2, Tencent found success by riding the wave of mobile internet, but there's no guarantee that it can stay at the forefront of next generation technologies. Number 3, Chinese regulators have become more assertive in recent years. There's the possibility the government may want more control over internet businesses by curbing monetization, limiting collection of user data, or restricting acquisitions. There's a balanced perspective of some of Tencent's qualitative factors. Now it's time for a rating. In analyzing Tencent, stock ticker TCEHY, we learned the company earns above average returns on capital of about 11.5% annually. That's down from the benchmark we'd be looking for. Tencent's grown their revenues, earnings, and free cash flows in the last 5 years. They've only very slightly diluted existing shareholders. Their free cash flows easily support their net debt position. Both their current and their average free cash flow to their enterprise value yield were coming in above the yield of the 10-year treasury, but down from the risk premium we'd be seeking. Tencent has also supported a growing dividend, very easily maintaining a healthy dividend payout ratio in the last 5 years. It's worth reiterating this analysis is not financial advice. When we performed our discounted cash flow analysis, if you've done the work and you believe those historical growth assumptions from today's valuations of Tencent, it looks like an estimate of their fair intrinsic value is around $31 per share. Combining the factors of our analysis, Tencent looks like a very strong candidate for further research. It helps that the business was likely Charlie Munger's most recent stock investment. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, comment down below what business you want me to look at next time. Thanks for learning about Tencent with me, and have a great day.